The US stock market is closed today, but risk is not closed. Wall Street may be quiet because of the Juneteenth holiday, and the New York Stock Exchange and Nasdaq may not be trading. But Bitcoin is still moving, oil is still moving, the dollar is still moving, and Fed expectations are still moving in the background. That is why this is not a normal, quiet market day. Sometimes the most important signal does not come from noise, headlines, or a big opening bell. Sometimes it comes from silence, when most investors think nothing important is happening. Bitcoin is now sitting near the $62,000 zone, after touching an intraday low around $62,263. That number matters because Bitcoin is not just another asset right now. It is acting like a risk sensor while the US stock market is closed. When Wall Street is closed, Bitcoin becomes one of the few liquid places where fear, speculation, and liquidity pressure can still show up in real time. If Bitcoin holds this zone, sellers have not broken the market yet. But if Bitcoin keeps bleeding while US stocks are not even open, Monday becomes a much bigger test. The real question is not simply, is Bitcoin down? The better question is why Bitcoin is struggling while some parts of the risk market still look strong. That contrast is what makes this moment uncomfortable for traders. AI stocks are still attracting attention. Nvidia was strong in the latest session, and QQQ was also strong before the holiday. That tells us the market is not completely risk-off. Investors are not running away from every risky asset. They are becoming selective, and that is where Bitcoin traders need to be careful. When liquidity is abundant, Bitcoin, tech stocks, AI names, and speculative growth assets can all rise together. But when liquidity becomes selective, the market starts choosing winners. Capital does not disappear, it rotates. And right now, one uncomfortable possibility is that capital still loves AI, but is becoming less patient with Bitcoin. That is the tension sitting underneath this market. Bitcoin is trying to defend a key psychological zone, while AI is still showing strength. Wall Street is closed, but behind all of this, there is another layer of pressure. Oil, the Middle East, the dollar, and the Federal Reserve are all part of the same background risk. This is the part many casual viewers miss. Oil is not just an energy story. Oil is an inflation story. If oil rises because of geopolitical tension, the market starts thinking about inflation pressure again. If inflation pressure comes back, the Federal Reserve has less room to turn dovish or cut rates quickly. And if the Fed stays tighter for longer, liquidity-sensitive assets can feel pressure. Bitcoin is one of those assets. So when we talk about Bitcoin at $62,000, we are not only talking about a chart level, we are talking about a macro pressure point. Oil affects inflation expectations. Inflation expectations affect the Fed, and the Fed affects the dollar and yields. The dollar and yields affect liquidity, and liquidity affects Bitcoin. That is the chain. This is why Bitcoin can look weak even when the stock market does not look completely broken yet. The market may not be saying, risk is dead. It may be saying something more specific. We still want AI, but we are not ready to reward every risk asset equally. That message is more dangerous for Bitcoin than a simple red day. A simple red day can reverse, but selective liquidity is different. Selective liquidity means every asset has to prove why it deserves capital. And right now, Bitcoin has to prove itself around the $62,000 zone. The other issue is ETF support. Earlier in this cycle, Bitcoin ETFs created a powerful narrative because investors believed institutional buying could absorb the dips. But when ETF flows weaken, that support becomes less reliable. The market can no longer assume that institutional demand will rescue every pullback. That does not mean Bitcoin is finished, and it does not mean a crash is guaranteed. It simply means the easy story is no longer enough. Bitcoin now needs confirmation. It needs to hold key support, it needs stronger demand, and it needs ETF flows to stop acting like a headwind. It also needs the broader macro environment to avoid getting worse. That is why Monday matters so much. Today, Wall Street is closed, so the market does not have a full vote. We do not get a normal US stock market reaction, full institutional participation, or the complete liquidity picture. But on Monday, the market reopens. And when it reopens, investors will react to everything that happened during the holiday gap. They will react to Bitcoin, oil, the dollar, Fed expectations, and whether AI momentum continues. They will also react to whether this quiet period was real accumulation or just a pause before another risk test. That is why the watch list is simple. First, can Bitcoin defend the $62,000 zone with real absorption? Not just for one candle and not just because of one headline. Bitcoin needs enough strength to show that buyers are still there. If it falls below that zone and cannot reclaim it, the market may treat the move as a warning, not noise. Second, does AI momentum remain strong? If Nvidia and AI-related stocks keep holding up while Bitcoin struggles, that means liquidity is still selective. Risk appetite exists, but Bitcoin may not be the main winner right now. Third, what happens to oil and the dollar before Monday? If oil pressure returns and the dollar stays strong, the market may start pricing in a tougher Fed backdrop again. That would not be friendly for Bitcoin, especially if ETF flows remain weak. And fourth, how does Wall Street reopen? This is the real confirmation point. If stocks reopen strong, AI stays firm, and Bitcoin holds support, the market may breathe again. But if stocks reopen weak, Bitcoin loses $62,000 and macro pressure builds, then today's quiet market may have been a warning. This is why the phrase matters. Market closed, risk open. A closed market can make people feel safe, but that safety can be false. Markets do not stop thinking just because one exchange is closed. Risk keeps moving through crypto, oil, the dollar, bond expectations, headlines, and investor psychology. And Bitcoin is often where that risk shows up first. So the question is not, should you buy Bitcoin today? And it is not, should you panic sell Bitcoin today? That is not the right framework for this moment. The better question is this: if Wall Street is asleep, why is Bitcoin already under pressure? And if AI can still attract capital while Bitcoin struggles, what is the market really telling us about where liquidity wants to go? Maybe Bitcoin holds, maybe Monday confirms risk on, maybe this is just another shakeout before buyers return. But if Bitcoin cannot defend the $62,000 zone while macro pressure builds, then Monday becomes the real test. Not because the market is closed today, but because risk is still open. And sometimes the most important market warning does not arrive when everyone is watching. It arrives when most people think nothing is happening.